Big outflows from CPFOA in 2025. Now I'm actually thinking out loud, and this is not confirmed yet that in 2025 there will be outflows. This again also is not financial advice. I'm just providing thought leadership, and I'm actually sharing with you my thoughts FOC, and I'm going to speak from the heart. Just in case you didn't know, recent news. From 2025 onwards, CPF special account will be closed once you reach the age of 55. You may still be employed after the age of 55, and this definitely impacts you. So not only impacts you, it impacts everybody who's now above already the age of 55. They would see their special account closed, and all monies from there will be moved to the ordinary account. Anyone from 2025 onwards above the age of 55 will only have 3 accounts: ordinary account earning 2.5% only, retirement account, and MediSave account. As mentioned in the previous video, retirement account, that one fits the CPF life, whereby you have no flexibility. You pump the monies in, it's good, but that one pays you monthly amounts and the monies are locked up there. So you got to be in good terms with that. So in this previous sharing, I've also shared that CPF shielding is gone already. You can check the links above. And from that video, I actually like this comment a lot. Josh, I know that you're trying to be neutral and you don't want to add fire to oil, but I fail to see how anyone in Singapore benefits from the abolishment of SA post age 55. Someone with $10,000, someone with 100,000 or 1 million SA, they all don't benefit, which is something that I agree and something you should be aware of also. Now, nobody benefits from this because we are end users and we're actually seeing a interest rate cut. Government benefits because the interest they'll pay out is less, 2.5% versus 4.08%. But again, this whole discussion is not about politics. And we also often forget that government officials, they also have CPF, so they are also taking a cut. And government's role is actually to allocate resources across society fairly. So sometimes we win, sometimes we lose. So let's not dwell too much about political speculation and stuff. But some people actually mistake this closing of special account as a punishment for shielding, which I also agree is pretty nonsensical. If government wanted to stop CPF shielding, simply disallow movement out of SA, which is also mentioned in this comment. So again, everybody has special account after age of 55, especially if you're continuously working, and we all are actually seeing this cut in terms of interest rates. So in terms of feeling sorry, let's keep it as there and move on to today's entire title. Why exactly do I foresee big outflows from CPF OA for anyone above the age of 55? Now, if you're financially savvy, in today's world, 2.5% guaranteed is peanuts, correct? But don't get me wrong, back in 2019, for example, 2.5% is godsend, government guaranteed some more. Back then, Fed rates were 1%, thereabouts. And in future, maybe if Fed rates start to drop again and global interest plunge back down to the 0 to 1%, then all this discussion is moot. But in today's world, we are in a high interest environment, correct? And we are very likely staying there for a long while. So as end users, we are faced with this dilemma: 2.5% guaranteed in CPF OA, or we should move the monies out to find better interest. Let me ask you this question. When GXS Bank created a hype account at high interest rates, and then after they cut their offering, what happened? People moved out monies from the account, correct? Savvy people are always looking out for better options. And government's 2.5% in CPF OA now really doesn't make the cut. Because quite simply, if you want to stay government-backed interest rates, what about Singapore Savings Bonds SSB? Why not, if you are above the age of 55 and you only have monies in your OA with 2.5%, why not draw it out and pump it into Singapore Savings Bonds? It's liquid, correct? It's government backed, correct? You can still take it out almost any time, correct? Why in the world would you keep 2.5% in OA then choose against this Singapore Savings Bonds? Yes, Singapore Savings Bonds has a cap, 200,000. It's DIY also, so it's not sold. You need to go online and buy. And that's why I also understand that most people are lazy. Just extra 2.5%, move here, move there. Some who are savvy will do it. Some who are just lazy, which I think most people are, they will just not bother. That's why I believe Singapore Savings Bonds is not likely going to be the biggest beneficiary of this whole entire change? Who would it be? You can take a guess. Let me share with you, it's none other than banks. Correct? Banks. Let me show you some offers to tempt you. If you are above the age of 55, let's simulate next year. Have some mental fun with it. Let me show you this by OCBC Premier Banking. Look at this. If you park monies with us, we give you base interest, 1.05%. And then if you don't make withdrawals, you continuously add in, according to terms and conditions, 2,000 per month. We will give you 3.7% interest. 3.7% interest. More than 2.5% interest, correct? What would the pitch be? Hey, Mr. Miss, pump in big amounts here and then every month, use 2,000 from your CPF OA, you draw it out and you pump back in. We'll meet the terms and conditions and you earn 3.7%. And not just that, every time when you come to our branch, I'll give you free coffee and I'll give you priority ang pao withdrawal from us. Cannot close, eh? I bet bankers would be selling this left, right and center, correct? What about Citigo? No, I'm not representing any bank. I'm just pulling up some examples that I hear from private clients because I don't park monies in banks. Bankers don't call me. I learned this from private clients that I work with. How about this by Citigo? Hey, Mr. Miss, you pump your monies that you saved out in CPF OA. You pump it in, I design a strategy for you. You pump in 250,000 fresh funds. You today will get a $880 reward, etc., etc. There are some other frills which I also don't understand. $880 ang bao from us, bird on hand eh. And if you got 500,000, you're a high income earner, you save a lot in CPF, you draw it out 500,000, jam it in, I give you 1,750 as a fresh fund rewards. Don't need to do anything, fresh fund rewards just for trusting our bank. Fantastic, correct? And I'll teach you, if you spend and earn 1.5%, you get it. Save and earn, just move 3,000 per month again from your CPF OA. We'll just design a strategy. Okay, draw up, pump in, draw up, pump in. You meet the terms and conditions. Total account interest rates 3% without doing any other things such as borrowing from us and investing with us if you don't like. So easy to sell, correct? You see what will happen? Banks will suck out a lot of CPF OA funds simply by thinking of a creative and good pitch which actually benefits the customer. So it's not right. There's something wrong with it. It's not. It's just a superior alternative. And banks will be the ones that's proactively pushing for this change, in my opinion, when I foresee what's going to happen in 2025. Again, that's not financial advice. Nothing is confirmed. But again, you see that there's a lot of logic. Your next question may be, hey Josh, I don't have so much CPF OA. Bankers won't call me like you. But hey, some of them will still call the retail side, correct? And let me show you some potential offers from fixed deposits. Hey, Mr. So-and-so, Miss So-and-so, why not draw your CPF OA after age of 55? You park it with us. I'll give you free ang bao also. You see over here, many banks can provide 3.5, 3.35%. So many different kinds of offers that you can get rather than idling your monies in 2.5% CPF OA. Why would anyone in the right frame of mind continue to kick 2.5% once they reach this phone call from a banker? Agree? Smash the like button as always because I'm sharing this thought leadership with you early so that you are well prepared when the time comes in 2025. And just in case you are young, you're not going to be reached there soon, you have parents, you have uncles, aunties that are going to receive these pictures or face with this dilemma. So do share this video with them. And as always, smash the subscribe if you like quality content like this that helps you understand finance a lot better. I'll also show you different things that I would do as a creator. Why not do a content that's fixed D ladder? If you have CPF OAs after age of 55, you can buy a lot of fixed deposits here and there. Buy this, buy that, build a ladder that can get you different maturity periods and all getting above 2.5%. Very easy to do, correct? So the conclusion again is quite easily bye-bye to CPF OA once you're above the age of 55, and it backs my personal opinion that there will be likely outflows. I come from the financial services industry. I would like to urge insurers also to get their teams to work a lot harder. Insurers, if you can build a product next year in 2025 suited for those that are above the age of 55, and you can get me 2.5% guaranteed, some upside also from non-guaranteed returns, because you have equity allocations in par funds, you have bond rates are going up, there's a lot of reasons to get a better offer. I can guarantee you, if you can come with such a plan, I can sell millions for you because, again, it's superior. It's a no-brainer. I'm helping people get more returns. So do something. Create par plans, savings plans, annuity plans, retirement plans. The market potential is just enormous because the benchmark now is not very high. And also, do add in flexibility before I forget to mention. Insurance plans nowadays are very dated. They don't have a lot of flexibility in terms of withdrawal options and interest. If you don't input enough flexibility to your withdrawal, my selling pitch should be against CPF Life, which is coming from the retirement account, and that one doesn't have flexibility but gives 4.08%. So there is a hurdle to cross. There needs to be flexibility. But also to mention, when you park monies in RA, the amounts you can't see already is going to be monthly cash flow. You can't surrender out. So get an insurance plan, you can surrender out with certain residual value. So I'd like to suggest this. If I can create an ideal product. Right now, I don't have the critical mass. Maybe one day in future I could. I would design something like this. Hey, a 2.6% guaranteed interest. Don't be 2.5, do 2.6. Because just in case some customers have HDB mortgage loans to pay off at 2.6%. I'd like to create a product that's 2.6% guaranteed and a little bit of just non-guaranteed upside. Good, right? Better already, and everything else is just upside. Third, option for regular payout. Just in case someone wants a flexible income stream, have that flexibility designed into that insurance plan. Fourth, of course, have flexibility in withdrawal. Once someone locks up for 5 years, they can fully withdraw or can take out 50% at any time. These are certain good considerations to design a product that is way superior, that can help a Singaporean move their CPF OA monies out after the age of 55 and get high returns outside. Hopefully all this makes sense. And I'd like to end things by answering this question. Hey Josh, everything makes sense what you've mentioned, but why aren't people doing it right now? Let me answer that also. In current situation with OA and SA, I don't know if you know this, but if you are above the age of 55 and you want to withdraw monies out, you have to take it out from SA first. SA gives you 4.08%. Taking it out is painful. The hurdle rate is high. You're not going to find fixed deposits at 4.08%. That's why for anyone with shielding done properly, they will be thinking it's no point moving my SA out just to access my OA. Or much rather buy OA fixed deposits or invest OA into T-bills. That's why the situation is still a bit different. But now the new rule is from 2025 onwards, SA will close, everything will be merged into OA for someone above the age of 55. By then, the opportunity cost is just 2.5%. No 4.08% barrier to block that decision making, just 2.5%. Do you want to stay or do you want to leave? The answer is pretty clear, and that's why today's title. As always, if you enjoyed this, smash the like button and check out this first episode that I've done on why CPF shielding is dead already. Or if you've seen that, check out this previous video. With that, sign off from here and see you there. Take care as always. Goodbye.